Hello, everyone. Thanks for taking the time to connect to our second quarter 2022 results conference call. This event is being recorded. Our speakers today will be our CEO, Mauricio Ramos, and our CFO, Sheldon Bruha. Following the prepared remarks, we will have a Q&A session. By now, you should have received a copy of our earnings release, which is available on our website, along with the slides that we will be referencing during today's presentation. If you turn to slide 2, you can see our safe harbor disclosure. We will be making forward-looking statements which involve risks and uncertainties and could have a material impact on our results. We will also be referring to many non-IFRS metrics throughout this presentation. We define these metrics on slide 4, and you can find reconciliation tables in the back of our earnings release and on our website. With those disclaimers out of the way, let me turn the call over to our CEO, Mauricio Ramos.
Thank you, Sara. Good morning and good afternoon, everyone. Thank you for joining us today to discuss our second quarter. Let's get started right away on slide 5. Earlier this year, we hosted our Investor Day. Back then, we shared with you our operational and financial plans to create shareholder value over the next several years. These plans are centered around our clear sense of purpose and reflect our commitment to focused ESG initiatives. The key message today is simply that we are on track to deliver on the commitments, financial and otherwise, that we made to you on our Investor Day. Since then, of course, the Ukraine has been invaded, interest rates have begun to climb, inflation has spiked, and there are increased risks of a US recession in the near term. Needless to say, we don't expect our business to be immune from a global economic slowdown. But, and this is a big but, so far, the impact of these macro disturbances on our business has been somewhat limited. 1, we had a very solid Q2, even ahead of our plans. And 2, although the going is getting tougher, for sure, and although we may lose some of the upside and leeway that we had hoped to have, as we look ahead, however, we remain very confident that we will deliver organic operating cash flow growth of around 10% on average over the next 3 years, as we said we would earlier this year. And we also remain very confident the business will generate cumulative all-in equity-free cash flow of between $800 million to $1 billion over those same 3 years, like we said at our Investor Day earlier this year. We've also continued to make meaningful progress on our plans to create separate companies for our infra and our fintech assets, and to carve these out from our core connectivity business in order to help them realize their full potential and for us to harvest the equity value we have embedded in those businesses today. In both cases, with the Towers carve-out and the Tigo Money carve-out, we expect to begin unlocking and crystallizing some of this value with transactions in 2023. Again, on track with the 12 to 24-month timeframe that we set out earlier this year. During the second quarter, we also strengthened our balance sheet by completing the rights offering we had designed to help fund the Guatemala transaction. And we also further advanced our ESG agenda with our climate targets now officially validated by the Science Based Institute. Now, please turn to slide 6 to look at some detail. Service revenue grew a healthy 4.5% in the quarter. This is consistent with our medium-term plans, is in line with our growth in Q1, and once again, a bit better than we had budgeted internally. And for a 4th consecutive quarter now, every country and every business unit grew service revenue organically. The fastest growth came from Colombia, which was up 8.5%. And we will talk about Colombia in a bit more detail later. From a business unit point of view, mobile continued to grow steadily, driven by our push into postpaid. B2B had a very solid quarter, accelerating to 5.7%, as anticipated, and with every country contributing to our strong performance. And home grew 3.5%, slightly below our plans, and there are various reasons for this. First is the shift to broadband-only subscription, which brings down ARPU. We mentioned this in Q1 and it continued in Q2. Whereas overall ARPU is compressed, the margins on our broadband-only product are actually higher, thus protecting our profitability. And our strategy to sell OTT products in what we call our content supermarket continues to advance quite well. Add this to our exclusive national soccer rights on many of our Tigo Sports channels across our markets, and the World Cup, which is coming around the corner, for which we have rights, and we should see more video add-ons in the second half of the year. The second reason is simply some more intense price competition, especially in Colombia. The third reason is that we have ourselves, and actually quite proactively, decided to slow down our sales to lower income customer segments, particularly in Colombia. We know from experience that these customers are more likely to churn as the economy slows down, so we wanted to get ahead of that by raising the bar on who we sell to and by maintaining our installation fees. We also wanted to focus our firepower to start selling on the footprint in Bogota that we will have access to going forward. And I will talk about that in more detail in a minute. With this new footprint to sell and our build activity now ramping up again, we do expect to see renewed momentum in our home business in the second half of this year. Now, please turn to slide 7 for a look at our EBITDA, which was up 4.6% organically in the quarter. Sheldon will give you a little bit more color on this later on. But the key message here is that even with all the FX volatility and the rising inflation, the macro concerns that we're seeing globally, and to some extent also in our markets, we actually grew EBITDA in dollars, both year on year and sequentially. Once again, as you saw during the pandemic, our ability to preserve and to actually grow cash flow is extremely resilient. It is also important to note that we have been investing in our Colombia mobile and Tigo Money businesses over the past year. We're now starting to see the service revenue growth pick up massively in Colombia, and that growth is dropping to the EBITDA line as well, as you will soon see. Now on to how we're tracking to our operating cash flow goals. On slide 8, you see that the phasing of our CapEx spend has been more front-ended this year than it was last year. This has been by design. We told you at the Investor Day that we see annual CapEx normalizing at around $1 billion. So you can see here that we expect to invest a lot less in the second half of this year compared to last year. As I said, this is by design. And this is meant to drive very strong operating cash flow growth in the second half of the year. As you know, we're aiming to grow operating cash flow by about 10% organically on average over the next 3 years, and we're on track for that. Now let's turn to slide 9 to look at Colombia, where we have now solved for 2 strategic challenges that had historically handicapped us in that market. First, on the mobile side, as you know, we were severely handicapped by a lack of low-frequency spectrum. We have solved for that fully, and now we're growing very rapidly, just as we predicted we would. Mobile service revenue growth is now almost 20% this quarter. Postpaid is the main driver of that growth, and the shift in mix from prepaid to postpaid drove ARPU growth of about 7% in local currency in this quarter. And this is good for EBITDA margins, which increased for a 3rd consecutive quarter in Colombia. The second challenge we had historically faced in Colombia is access to the fixed broadband market in the key city of Bogota, the largest city in the country, where it was virtually impossible for us to build a citywide network, particularly in the most attractive neighborhoods of Bogota. That's why we are so pleased to have announced a few days ago that we have signed deals with both ETV and Ufinet that will allow us to use their open fiber networks to provide Tigo-branded home services in Bogota. On a combined basis, these deals more than double our footprint in the city and give us access to sell an additional 1.5 million homes in Bogota without us having to deploy any CapEx upfront. We actually look forward to serving more home customers in Bogota in the near future, and we also expect that this will help sustain the very solid performance we now see in Colombia. Now let's talk about Tigo Business on slide 10. As you know, we refocused our B2B strategy just before the pandemic, so it is nice now to see the results begin to come in. B2B service revenue accelerated to more than 5% in the quarter. Every country is contributing to our success. This is because the strategy is pan-regional. This strategy, as you know, focuses on 1, adding SME customers, which is a key growth segment for us now and going forward, and 2, deploying advanced digital and cloud services to our corporate clients. As you can see on this slide, the new strategic design is working extremely well and making us continue to be very bullish for the outlook for B2B going forward. Now, let me give you a quick update on our progress to carve out our tower and our Tigo Money businesses, beginning with the towers on slide 11. By now, most of you know that our portfolio of more than 10,000 towers is already the 5th largest in the region, and that we're planning to build more than 1,000 towers per year going forward. So there is significant growth potential for this asset just from the towers coming from us. The entity will also start out from a very low tenancy ratio, so there is further opportunity for value creation in that regard as well. Over the last several months, we have completed most of the corporate structure planning and preparation, and over the next several weeks, we will be drafting the corresponding MLAs. We expect to start transferring towers later this year and into the early part of 2023. And we are on track to execute a transaction next year, as we indicated during our Investor Day. As you know, we aim to bring in a partner to provide growth capital for the tower businesses. We want to allow this infra business to reach its maximum potential because we want to own a part of this infra play to create value for Millicom. For now, we're keeping our options open in terms of whether we will sell a majority or minority stake, and on whether we will go with a financial or a strategic investor. We will cross that bridge when we get there. As for Tigo Money on slide 12, we're also progressing very nicely. We have largely completed the initial software development that we needed to roll out Tigo Money 2.0. This will allow us to consolidate the 3 platforms in 5 countries into a single scalable platform across all our countries. We're also rolling out our merchant platform as planned and as on track. And 2 weeks ago, we started to pilot our lending activity. As you know, Tigo currently serves approximately 50 million mobile and residential customers. So we have a wealth of knowledge about their spending habits, which will be very helpful as we look gradually to expand in this area. And finally, we continue to work with our financial advisors to prepare the company to bring in an investor who can provide growth capital and some relevant fintech experience. And as we said during our Investor Day, we're targeting a transaction in early 2023. Finally, on slide 13, Q2 was an important quarter in terms of advancing our agenda as an agent of positive change in the region. We joined the White House Partnership for Central America, and we actively participated in the Summit of the Americas in LA just a month or so ago. And on the right-hand side of the page, you will see that the SBTi recently validated our emissions reduction targets. So we're on track on this commitment as well, and we're pleased to already be executing on our plans to deliver against those. Now, Sheldon will go over the financials for the quarter.
Thank you, Mauricio. Let me now take you through the Q numbers, beginning on slide 15. Service revenue is $1.3 billion in the quarter. That's up 39% year on year due to the Guatemala acquisition. Excluding the acquisition, organic growth was 4.5%, which is about the same as our Q1 and consistent with our medium-term target of mid-single-digit organic growth. Our mobile business grew almost 5% and contributed more than half of the overall growth in the quarter. And the majority of this mobile growth came from postpaid, which continues to perform strongly and grew 9% year on year. We continue to reap the benefits of the additional investments we've made in some of our mobile businesses over the past couple of years, especially in Colombia. Finally, Forex detracted from reported growth this quarter, largely due to the Colombian peso, which depreciated about 5% on average compared to a year ago. Like most currencies globally, the Colombian peso has continued to weaken compared to the US dollar since the end of the quarter, but many of our other currencies, like the Guatemalan quetzal, has remained very stable. Drilling down further on slide 16 to service revenue by country. Once again, every country showed positive growth, with Colombia leading the pack with 8.5% growth, fueled by the mobile business, which was up almost 18%, thanks to our very robust growth in postpaid, as Mauricio mentioned. The shift in the mix towards postpaid has also lifted ARPU, which increased nearly 7% year on year in Colombia. Elsewhere, we saw El Salvador and Nicaragua maintain their strong momentum with growth of about 7% in the quarter, with solid growth in all 3 business lines. Panama and Bolivia grew more than 2%, as did Paraguay, net of a negative one-off for that business in Q2 of last year. All 3 countries are showing good momentum on a sequential basis, with revenues higher in Q2 compared to Q1 in almost every business line. Guatemala grew 1% in Q2. This is similar to the growth we reported in our Q1 and in line with our plans for the year. There were also some positive signs in Guatemala this quarter. Our handset sales grew more than 20%, so consumer spending is in good shape. And we saw good growth in both our mobile and home businesses on a sequential basis compared to Q1, as we continue to solidify our competitive position in the market. Okay, turning to EBITDA on slide 17. EBITDA of $577 million was up 68% year on year due to the consolidation of Guatemala. But organically, EBITDA grew 4.6%, in line with our service revenue growth, and a meaningful acceleration compared to Q1, which was flat. You recall that we are beginning to lap the investments we've been making in consumer acquisition in Colombia and in our Tigo Money fintech business over the past year. Also impacting the year-on-year comparison was about a $10 million higher level of bad debt in the quarter versus prior year. Most of this was related to our lower than usual levels of bad debt provisions in Q2 of 2021 as we adjusted to payment trends from COVID. And this has now reverted back to more normal levels in 2022. However, a smaller portion was related to a little lower level of collections in the current quarter, which we are actively managing and monitoring in light of the current economic environment. Finally, given the backdrop of rising inflation and the strong dollar, we are seeing some pressures on energy, labor, and programming costs. That said, our EBITDA margin for the group was just shy of 40% for the quarter, roughly unchanged from both the prior quarter and the prior year, demonstrating our ability to offset these pressures with savings elsewhere. Now looking more closely at EBITDA performance by country on slide 18, once again, El Salvador led the group with EBITDA growth of more than 10%, with margins improving year on year. In both Colombia and Panama, EBITDA grew by more than 8% after adjusting for one-offs that largely offset each other. In both countries, the strong performance in mobile is lifting margins. In Colombia, this is the third consecutive quarter of margin improvement, while in Panama, margins are approaching the 45% level. Bolivia performance improved noticeably in Q2, with EBITDA up more than 7%, although that's against an easier comparison. Nicaragua also performed well on EBITDA, but this was against a very robust Q2 last year, which is why growth was only 1.5% this quarter. Paraguay EBITDA grew 4%, but this was down 2.5% after adjusting for last year's one-off. This decline was due to the phasing of some of the selling and marketing costs, which included a new campaign to support our Tigo Money business. Honduras was down 1% year on year, but the business continues to generate very healthy cash flow and returns on capital. And $65 million is the strongest EBITDA we've seen from Honduras since Q2 of last year. Moving to slide 19, you can see how our operating cash flow, that is EBITDA less CapEx, compares to the previous year. OCF more than doubled to $322 million in Q2 due to the consolidation of Guatemala. Organically, it was down less than 1%, and that's because of phasing of our CapEx for the year, as Mauricio discussed earlier. We expect to see strong OCF growth in the second half as EBITDA is growing again, and CapEx spend is not expected to increase too much from the first half to the second half of this year, as compared to the record CapEx we spent in the second half of last year and in Q4 in particular. The key message here is that we are on track with our plans for the year. In fact, our service revenue, EBITDA, and OCF were all slightly ahead of budget in Q2. And we expect organic OCF growth for the full year 2022 to land at around 10%, right in line with the plans we laid out at the Investor Day. The next few slides I'll cover capital structure and capital allocation, beginning on slide 20. During the quarter, we completed the rights offering aimed at funding a portion of the Guatemala transaction, and we used the proceeds to repay the remaining $450 million on the bridge loan. During the quarter, we were informed by our former partners in Panama that they plan to divest their 20% stake, which we then acquired at the end of June for about $290 million, as per the terms of the initial transaction back in 2018. Panama has become an important contributor for the group cash flow, and we are happy to now own 100% of this cash-generating asset. And on slide 21, we summarize some of the highlights of the Panama business. Number one in mobile and in fixed, and with very solid EBITDA and OCF margins. An investment grade and dollarized economy, and a much improved industry structure, with the recent exit of Digicel from the market, as well as the merger of Liberty and Claro's Panamanian businesses. So an industry that is in the process of becoming a two-player market. Finally, let me close on the leverage situation on slide 22. A lot of moving parts here, but let me try to summarize the movements during our first half of the year. Equity free cash flow, excluding Africa, was negative $62 million. This is in line with our plans and consistent with the usual seasonal patterns, which primarily reflect the first half weighting of annual cash payments for income taxes, frequency and software licenses, variable compensation, and for higher levels of CapEx booked in Q4 but paid in Q1. As a result, most of the equity free cash flow for the year typically comes in during Q4. This negative equity free cash flow was offset by $88 million benefit from the Forex translation on our local currency debt. Then we have the rights offering that we already talked about, and finally the African exit, which basically offset the purchase of the 20% minority in Panama. So we ended Q2 with just shy of $6.1 billion of net debt. That's down about $730 million since the start of the year, reflecting the rights offering, and net debt to EBITDA after leases was 3.04 times. If we include the leases of just over $1 billion, our leverage was 3.14 times at the end of Q2 versus 3.46 times at the end of Q1, a 32 basis point improvement. And our plan is to use the equity free cash flow we will generate in the second half to pay down gross debt and reduce our leverage. And we expect our leverage to be around 3 times at year end, slightly higher than our previous guidance, given the buyout of our 20% partner in Panama. So with that, I'll turn the call back over to Mauricio to wrap up.
Thank you, Sheldon. As you can see, we had a solid Q2, slightly ahead of our plans for the year. Now, we are very aware that macro conditions have gotten tougher and that there are challenges ahead that we hadn't quite foreseen at the beginning of this year. But we also know, and you know this, that we have the ability, as we demonstrated during the pandemic, to drive and grow our operating cash flow and our equity free cash flow, even in the most difficult of circumstances. Ours is a very resilient, a very cash flow resilient business. And that is why we're confident, despite the more difficult circumstances, that we will be able to deliver on all the commitments we made to you earlier this year. The commitments that are laid out on this page. We remain confident and committing to delivering on all of them. And that is why I, the board, and my colleagues subscribed to the rights offering that we just finalized a month or so ago. It's a sign of the confidence we have in our business and the sign of the confidence that we have that we will be able to drive shareholder value for you going forward. With that, we'll take your questions now.
Thank you, Mauricio and Sheldon, for your remarks. We will now begin the Q&A session. As a reminder, if you would like to ask a question, please let us know by emailing us at investors@millicom.com and we will add you to the queue. When I announce your name, please unmute your line and make sure that your device and camera are turned on. Please limit yourself to one question and to one follow-up so that we can give everyone an opportunity to participate. Finally, please unmute your line after you've asked your question. Our first question today will come from Claes Danielsson at Nordea. Claes, the line is yours.
Yes, thank you very much. So hi, Mauricio, Sheldon, Sarah, thank you for taking my question. So a couple from my side for sure. So you're starting on the cash flow side. I mean, it's clearly a strong outlook that you're giving for H2 on the OCF side here. Clear kind of growth from the levels in H1. I think looking at equity free cash flow, that's still lagging a bit. So my question is, do you expect the kind of incremental OCF in H2 to kind of fully drop through to the equity free cash flow levels, or are there any kind of other dynamics affecting in there?
So I'll give you, Klaus, and thank you for joining today, just a kind of a quick overlook, and I'm sure Sheldon will give you a lot more color. I think the key message today, the word that I would continue to emphasize is that we're on track to the metrics and the goals that we set out during Investor Day. And that means that we're confident we're going to deliver that OCF growth 10% on average over the next 3 years. And that, if you work through the math, will get you to the equity free cash flow of $800 to $1 billion that for the 3 years on a cumulative basis we'd set as a target. We're on track for that. What we wanted to highlight today is, and hopefully we did that quite well during the call, is that the nature of the animal here is weighted or back-ended towards the second half. And that's why you began to see this quarter, as we anticipated it would, that EBITDA has begun to accelerate on the back of the service revenue growth that we currently have. and that we expect OCF will accelerate significantly so during the second half, getting us to be able to deliver on those targets that we have set out. Sheldon, over to you if you want to add.
Yeah, sure. Thanks, Mauricio. And hi, Klaus. And I made a few comments on this in the prepared remarks in the presentation, but we do have a higher level of cash outflows in the first half of the year versus the second half of the year, and there's several reasons for that. A lot of our income taxes essentially go out in the first half of the year once we complete the financial returns. We do prepay a lot of frequency and software licenses in the first half of the year for the full year. Variable comp goes out, as well as we had a high booking of CapEx late last year as we finished a lot of projects. The cash payments for those spilled over into this year. So those are kind of the working capital dynamics of our group. So higher cash outflows first half, then it sort of recovers during the second half, and that's the dynamic it played out in years past and what's playing out a bit this year as well. So it'll be easier, I think, once we sort of lap this, this first year here, to be able to show you equity free cash flow on a rolling 12 months basis. For the moment, you're kind of looking at it just on a 6-month basis. So that's so you're kind of you're seeing that dynamic, but only a partial picture of that. But look, we expect equity free cash flow to be a strong number, or certainly a very material positive number this year, and in line with the trend line of what we're looking to get over the next 3 years of $800 to $1 billion. So that's the additional comments I'd say on that.
Okay.
Yeah, and just to give you a little bit more color, because I imagine, Klaus, this is super important. Colombia and the delivery of what we said we would do in Colombia is helping a lot. Margins are expanding on EBITDA. We're lapping the investments that we had made before. We're adding subscribers, service revenue is increasing, EBITDA margins are growing, OCF is expanding, so that's helping tremendously. Guatemala remains the equity free cash flow producer that we were very happy to buy, so that's helping on that level quite significantly as well. And the investments we made in Panama, as you've seen from the results, are giving us one of our highest OCF growers, and as a result, a strong contributor to equity free cash flow. So things are coming into place as we hoped and anticipated they would.
Fantastic. And just to kind of follow up, lots of questions here, obviously I would ask, but to try to limit myself to one question, I guess. So just on a kind of higher level and on the CapEx side, I mean, it's clearly been the case for you the last few years where you've been focusing on the 4G side, and that's kind of pulling back a bit. I mean, I did notice this quarter, I think both you and América Móvil launched 5G, kind of still at a small scale in Guatemala. But still, and I think looking ahead there, do you still see the kind of investment cycle in 5G as being a few years away from now, or how are you kind of envisioning that side from here?
A great question, Klaus, and thank you for bringing it up, because of course, as we say these things publicly to you, our investor base, we also need to weigh in the way things are playing out politically in each one of our markets. And I think the Guatemala example is a perfect example of what we said earlier during Investor Day. So just to answer your question holistically, we said back then, and we totally are beginning to see that to be the case, that there's really no gotcha moment here in terms of a CapEx spike up because of 5G or fiber investments, as you recall. And we said that we expected our CapEx spend to be right around $1 billion per year on CapEx. And you just seen us reiterate that, and as a result of that, consistently say we're going to deliver on our OCF, and as a result of that, on our equity free cash flow target. So nothing really has changed. We also said back then that part of the reason we've laid out these very careful 3-year plans is because we already own a ton of 5G spectrum, and Guatemala is a perfect example of that. We launched Guatemala on the back of the 3.5 spectrum that we already had. And although there are no other planned 5G auctions, politically, there's always the moment, the discussion between presidents and others as to when it should or shouldn't happen. But when you look at the way Guatemala worked out, is exactly what we said would happen. It is not a big gotcha moment. There's no disruption in the marketplace as a result of this. It is a non-standalone 5G network. As a result of that, it can be done, has been done, and will be done within this CapEx envelope of a $1 billion that we described. And it's just one more operational delivery that we have done. And as a result of that, when
Oops, we lost Mauricio there.
Yep.
Well, look, I think I'll just kind of follow up there. I mean, I think we've, as he's highlighted, I mean, there, we still can. Oh, there you are, Mauricio, you're back. You just dropped off for a second.
Oh, did you not hear everything I said?
We just missed the last 30 seconds.
Okay, well, basically said, I think that the punchline was that the Guatemala launch is the perfect example of the concept that 5G for us will be done within the $1 billion capex. We just launched 5G in Guatemala, largest market, no big gotcha moment for you. It's done, it's out in the market, cost no disruption. We did it on a non-standalone 5G technology, as you would expect we would. We did it on a spectrum that we already own. And we're doing it within the CapEx envelope. So we're not changing the $1 billion per year because there's no gotcha moment. It's going to be done not on top of, but as a part of that $1 billion envelope. And thank you, Sheldon, for letting me know that the punchline had now been heard.
Sure.
Fantastic. Can I just leak in one last quick question?
Sure.
Yeah. Great. No, just lastly, kind of there's was I guess some commotion on you noting that you received a subpoena from the DOJ earlier this year within the rights issue process. Could you kind of update us on that? Has there been any developments or anything to comment around on that side?
Yeah, I think you're going to hate my answer and how boring it is. I'm probably going to be, develop no news for you. We did receive a subpoena in April of this year. Basically what a subpoena is, it's a request for information. The only difference is that you have to provide the information. There's really not a lot more that I can tell you or anything that has really happened in terms of timeline or content with regards to that. We actually don't know what the DOJ is effectively investigating. What I tell you is that we are cooperating the fullest. And when I say the fullest, I mean the fullest with the DOJ. Because we simply want to be and continue to be that agent of positive change in the markets. And as you very well know, since we self-reported some years ago, we have become and made significant investments to become what I deem to be the gold standard in compliance in the region. So there's a part of me that is enthusiastic about showing that side of us to the DOJ, even if it's in the context of a subpoena. That part was not in the script, that part was not legal, but it gives you an idea of the fact that we really want to showcase to them that we are really very compliant.
Yep. Fantastic, Maurizio, Sheldon, Sarah, everybody. Thank you very much for taking my questions.
Thank you,
I get
Klaus.
a little bit of help from the lawyers on that last point, but heck, that is what I feel.
Thank you, Klaus and Mauricio Sheldon. Our next question will be coming from Stefan Goffin from DNB. Stefan?
Yes, hello. Colombia is progressing really well, and right now what we are seeing is it's high inflation, really large currency movements in Colombia, and now you also mentioned increased cable competition in Colombia. So. Can you elaborate a little bit about these impacts and how you're seeing that you can handle these issues? Especially, I think that the pay TV margin can be impacted by the currency movements.
Yeah, awesome. So Colombia, let me start with, and yours is, Stefan, a very holistic question. So let me approach it in a very holistic manner because there's a lot of moving pieces in Colombia. Number one, the results are nothing short of service growth, even by mobile and with margins. EBITDA expansion and OCF expansion. So pretty happy with the performance of Colombia. The macro outlook and political outlook, if you will, despite the spike in currency, is actually turning out to be less dramatic than we had ourselves prepared for and anticipated. When you look at all the cabinet members that the Petro administration has put in place, all of them have been a part of prior administrations. So the sense that you get is this is not a radical change. This is a continuity in the political elite that has been managing the country. So we take some significant relief from that at the macro and political level. Now, at the operating level, I will speak little about mobile, and your question kind of belies or underneath it is the notion that we really are working well now in mobile. All the questions before were about mobile, and today we're growing almost 20% of mobile and adding postpaid subscribers every quarter consistently. On the home business, which I think is your point here, I want to point your attention to some of the things that are in the market and some of the things that we ourselves have been driving. So earlier this year, as I alluded, we made the call to move away from selling in some of the lower socioeconomic segments because we didn't think we were getting a return on capital there. And we thought we should be doing far better focusing our efforts on the high socioeconomic sectors of the country. And that already is beginning to work well, and you'll see that come through later on in the year and into next year. Obviously, the transition period means that you have to reshift your sales and your distribution to new areas, and that causes a dip. So that's part of what's going on in there. There is increased competition, as we mentioned, and I think Millicom Mobile mentioned in there, but we're actually quite confident that we're going to regain quite a bit of growth on Colombia because of the new sales strategy that is going to be less churn, longer lifetime cycle value of our customers, a little bit better ARPU, but also for a number of other reasons, which I think are very important. Number one, the World Cup is coming up, and that's going to put a big push on sales. Number two, I think there's a little bit of just the ebb and flow of the pandemic, and I think that will wash out and we'll start to receive some growth going forward. So that's more of a short-term effect. And most importantly, and this will be, I think, relatively important, we now have the ability to sell into 1.5 million homes that we didn't have access to before. And I mean no access whatsoever. So this is 1.5 million homes in Bogota. They come as a result of the open fiber deals that we struck with Ufinet and more importantly with ETB, which will allow Millicom Tigo Colombia to finally sell to that subscriber base in Colombia. And that's important because if you recall, 2 years ago, we barely had mobile access to Bogota because our network could not penetrate high density, high rise buildings because we were just basically on high frequency spectrum. Today, we will be able to service Bogota, 30 to 40% of the nation's GDP with both a mobile product, which is winning in the marketplace, and a home or broadband product, which is really, really important in that marketplace. And we will be able to do that second part on a CapEx light or variable cost or success-driven model, which we're very eager to test in Colombia, and particularly because, of course, given that this is an area that already has some penetration of cable TV, we would rather come in, since we're not going to be the new entrants there, we would rather come in with a success-driven model. So we're very happy to have achieved this model. So I think you can expect a lot more of Colombia on the fixed side of the business going forward. And while I'm on fixed, B2B in Colombia, as elsewhere, is beginning to become a real engine of growth. It really grew at around 5.5% this quarter. And we see nothing but continued growth there. So holistically, Colombia at an operational and a financial level is becoming a better place for us. And I mean this significantly. The results are good. We're winning on mobile. We're bullish that we now have access to sell on cable. We've rejigged our strategy to the better part of the socioeconomic period. And we now have the ability to sell to Bogota. So yes, there's more competition, But when you look at the whole picture, we are far better in Colombia strategically and into the longer term for our fixed business than we have ever been in the past for the reasons that I just mentioned.
Can I just ask one question around the Bolivia, where you say you changed the commercial strategy, which resulted in loss of prepaid subscribers. Can you just describe what you're doing and what you're seeing in that market?
Simple. These were Sheldon, you may need to help me out here with the right wording for these. These were not good subscribers. All right. So this is not a cleanup. This is not a, this is basically very low ARPU, almost no ARPU subscribers that we were spending a lot of money trying to service and keep. So we basically, with the local team, agreed on the fact that, hey, that KPI is not going to look good for a quarter or two, but you know what? What ultimately matters here is OCF and equity free cash flow. So just go ahead and shed them, and we'll be happy to not live with those subscribers, even if we have to answer a question or two on the matter, and we'll keep the good ones. And as a result of that, you see that the service revenue in Bolivia, on mobile I'm talking, the service revenue in Bolivia, despite the competition from Entel, is stable in Bolivia. By the way, on Colombia, please don't miss the ARPU stabilization and improvement that you've seen this last quarter. I probably missed the most important thing on Colombia. Sorry to go back, Stefan, but my mind lost a heartbeat there. So on Bolivia, the issue is just as I described, and we're happy that Bolivia, with the difficulties that we're having, is showing mid-single-digit growth in home. We continue to build quite a bit in Bolivia. As a matter of fact, it would be growing more than it has done in the first half of this year if we had not had some delays in the build in Bolivia. Quite honestly, we were a little bit delayed in Bolivia, 3 months or so, and that causes some delay in our ability to grow on home in Bolivia, but we're back on track. And B2B is also growing in Bolivia. So Bolivia is really, really improving. And you see that on the EBITDA, which is up this quarter, 7% or so.
Okay, perfect. Thank you.
Thank you, Stefan. As a reminder, if you would like to ask a question, please email investors@millicom.com and we will add you to the queue. Our next question will be from Vitor Tomita from Goldman Sachs. Vitor? I think you're still on mute, Vitor.
Sorry. Good morning, everyone, and thanks for taking our questions. First one would be regarding the acceleration in B2B. You mentioned briefly the performance in Colombia and Bolivia. Could you give us some more color on which countries and on which types of digital services have been the main drivers there? That would be our first question.
Yeah, so the answer is very straightforward, and I'll be fast and sweet on this one, and then I'll elaborate a little bit as I always like to do. So the first part of the question is broad-based. It's across all countries, some more than others, but across all countries. So Panama is doing well, Colombia is doing really well, Paraguay is doing well, Guatemala is doing really well. So it's all countries, some more than others. Very simple. The second part of the question is, what about digital? It's basically cloud services.
Sorry, we lost Mauricio. Hopefully he'll reconnect here just in a quick second. But look, I'm just expanding on what he was saying around the digitals. These are cloud services. This is going to be hosting and security.
Our strategy.
Okay. Mauricio, we just lost you there for about 20 seconds again.
All right. So you got the part on what the digital services are, Victor?
Yeah, that's exactly
true. Cloud services, yeah.
Okay, so it's cloud, cybersecurity, and SD-WANs. Now, there's 2 really segments that are working very well for us. And remember, this is a strategy that we put in place before the pandemic. During the pandemic, we took the time to continue to implement it and develop. And by this, I mean changing the product line, changing the distribution, training the sales forces, being a lot more focused on what we do. And the 2 segments that are really growing behind all this is the SMB sector. You know what that is? That is growing 8-9%, and that is straight up. We've added to that sector maybe 30 to 40,000. I could be off on the right numbers here, just in the last year. So significant additions there. And the second sector that's working really, really well is the SMB, the corporates. And that's on the back of the digital services that I've just described, which encompass the three things that I just described. And the growth there is volume driven. We've added some 10,000 accounts, give or take, but significantly ARPA driven, because these services are really demanded for. So it's allowing us to have nice volume, but most significantly ARPA growth in corporate. And we do expect this to be very resilient going forward, by the way.
Thank you. And just as a follow-up question to that, if cloud continues to be a main driver for B2B growth, do you believe that will have any implications for thinking about margins or CapEx, given that this can be more of a CapEx light segment, but might also require some infrastructure on the other hand?
It's early days for us, but as we began to analyze all these almost contract by contract, we quite frankly, we love the returns on this because they are, I wouldn't say immediate, but they're very tangible returns. They can be analyzed very, very efficiently. So we'll be happy to take that equation. Sheldon, I know you've been looking at this quite a bit, so feel free to jump in.
No, look, I think you're right. I mean, you look at the what we're contemplating here around this expansion and growth on B2B. Once again, easily accommodated within sort of our CapEx envelope, and we do look at these sort of on a project by project basis as well for these larger ones. And certainly all of these are meeting our return thresholds as we move through this migration and growth in our B2B segment.
Very clear. Thank you both very much.
Okay. There's also a part of me that loves the idea of building a significant data center business as we are on the back of all of this. You already know that we own 13 of those. They're all tier 3. We keep building them out. So there's a part of me that likes the notion that this is helping us drive the creation of basically a data center business. I'll stop there because I know what the next question is, and I really don't want to answer that next question.
Thank you very much.
Thanks, Vitor. Our next question will be from Marcelo Santos at JP Morgan.
Hi, thank you for taking the question. I would like to ask a little bit more comment on the fixed service environment in Paraguay, especially I think the piracy issue that you mentioned.
Yep. Got it? All right. So listen, piracy in Latin America, as you know, Marcelo, has always been an issue. And sometimes the grass, as I like to say, starts to become a little bit too high. And then the time comes for a severe cut down of the grass. We do that every year. And Paraguay was getting a little bit out of control on piracy.
Yeah, I'll just step in here again. It looks like this connection's a challenge, but no, look, we've worked with authorities there. We're able to sort of identify a particular large abuser on on piracy in that country, and we're able to work with the authorities to shut that one down. And okay, you're back on. We lost you there for about 10 seconds again, Mauricio.
No, keep going.
No, I was just mentioning that we were able to work with the authorities to shut down quite a large piracy operation there in the country. I think they seized almost over $200,000 worth of equipment, as part of that. I think importantly is, hopefully that, that remedies a bit of that activity. I think it also sends a strong message, I think, to other participants or other players in that arena within the country. But look, I don't think, I think we do recognize it also. This is ultimately a bit part of the, part of the, of the industry that we kind of play in. And as Mauricio sort of said, this stuff will continue to pop up. We'll continue to be aggressive and try to work with, work with authorities, quite frankly, work with the content providers as well, and trying to crack down on this and, and preserve sort of our, our pay activities as we do so.
So 2 comments on these things that I saw that were significant, Marcelo. Number one, the sheer focused involvement of the authorities in Paraguay. It is actually larger, more enthusiastic, more professional than I have ever seen. And number two, as a result of it and the media display that we put on it, a lot of these pirates have actually said publicly they're going to get out of business. They don't want to lose their investments as they have lost, and they don't want to look at fines or imprisonment. And on your larger home question, the base is growing. The base continues to grow. There is in Paraguay some of that migration from bundle, if you will, to broadband only. Piracy was a part of that, of course, right? Of course, because you can pirate the content and you won't pay only for the broadband connection. So this will help in that. Our continued push into selling what we call the content supermarket, i.e. selling more OTT as an add-on service, will continue to work because that's additional add-ons that are sold and nobody can add. And into the second half of this year, remember the Paraguayan soccer will begin in the second half of this year. So that will drive, we hold those rights. And of course, there's a World Cup that will drive. So there's some momentum that should restart in the second half of this year. That's the Paraguayan pay TV and broadband story.
Perfect. Thank you. Very clear.
And by the way, while we're on it, Paraguay is back on growth. Just let not that be unnoticed. Both service revenue, subscribers across the board, etc.
Very clear. Thank you.
Thank you, Marcelo. Our next question will come from Andres Coelho at Scotiabank.
Yes, hello guys, good morning. I'm trying to get clean numbers for equity free cash flow, and I was wondering if you can please help me clarify how much extra OPEX and CAPEX was used to support your initiatives in infrastructure and also in the fintech business. How much money you are using to make this a reality next year in terms of OPEX and CAPEX? And a second question, if I may, on Guatemala. I would like to know when you expect Guatemala to go back to growth, how long that's going to take you, because we've seen a weakness in Guatemala in recent quarters. Thank you.
You bet. So I'll take the Guatemala question and perhaps give you the first one to you, Sheldon, on equity free cash flow. The only thing I'll say on equity free cash flow before I hand it over to Sheldon is fintech is basically accounting and
okay, lost his line again. Why don't I just pick up a little bit on your questions and try to give you some color on those two investments. Look, I think we've mentioned. Sorry, Mauricio, you were cutting out, but I was just picking up perhaps on some of the numbers. You had asked just sort of the investment. I think we've highlighted earlier in the year kind of the type of annual spend we're looking to incremental spend we're spending on fintech this year. It's in the order of $40 million. On the full year basis. That started ramping up very late last year, and we're kind of seeing sort of a full year of that now this year. Now, most of that is going to be OPEX. There'll be a portion of that as CAPEX, but from an annualized basis, you should plan on about $40 million of investment there for the full year for that activity. And look, and I think that's what's important to highlight is we've been commenting about our equity free cash flow growth. Our operating cash flow growth of 10% on an organic basis. That is growth after absorbing about $40 million of incremental spend for MFS as we invest in that growth opportunity. So that's MFS. We haven't commented specifically on infrastructure investment. On the towers investment for that carve out. I will say there will be some costs ramping up on that. You'll probably see that coming through our corporate costs a little bit as we move through the year, as we stand up sort of that entity and start investing in the aspects of be able to transact with that as we've highlighted in 2023, which is our objective. So I don't think we're guiding specifically on the number, but just expect some incremental corporate costs as we roll through the year to stand up that amount.
Okay, thank you. Very clear.
And to add to that, Andres, as I seem to be back on Tigo Money, and I'm looking beyond this year. We were all, including likely you, perhaps not as buttoned up on, what would be the cost of ramping up and launching Tigo Money B. And the reality is it's demonstrating and proving to be less than we had anticipated. So we're happy with the fact that the business launch, enhancement, Panama, et cetera, particularly into next year, is going to be less expensive, if you will, than we had anticipated. So from my point of view, I am happy that is not a investment that, important as it is strategically, is going to continue to have meaningful impact on dragging our cash flow down. I'll stop right there because I'm going to make some guys in the finance group really, really nervous. I can already tell Sheldon kind of ready to push the stop button. On Guatemala, which is a great question, because it allows us to now share with you a little bit more what our plan is and what it was on Guatemala. So let me begin with emphasizing that Guatemala is doing exactly what we expected it to do, which is to be a solid and steady grower with massive cash flow generation. And it's on track to do that for this year. It's just an engine of cash flow. That is what it's supposed to do for us. In terms of growth, rather than answering your question directly, because then I'll make everybody on the call very uncomfortable on the finance group, I will point you to the difference between Guatemala and some of the other businesses. Guatemala continued to grow during the pandemic. We gained market share. We inched up in revenue. We increased margins. So what you're seeing now is just tougher comparisons than the rest of the group. So I know you're very good at math, Andres, so you'll do that, understand that if you average out, Guatemala remains a steady grower. Now, when you look at what Guatemala is going to do going forward, not just in terms of cash flow and what it does for the portfolio, but in terms of growth, which was your question, think of mobile for us as we having cemented our leadership during the pandemic. You know that we took some market share. We know that we now need to stabilize that market and that we're not growing on postpaid. So that's what we aim to do, drive growth on mobile and postpaid. Now, if you look at the other business lines in Guatemala,
Yeah, sorry, looks like you got frozen again. Look, I think it was highlighting though, we have cemented our leadership here on the mobile side, and throughout the pandemic, and what you're seeing now. I think, quite frankly, where our growth within Guatemala is predominantly coming from is on the home and the B2B side, where sort of we're actually now leveraging that leading market position and high market share position on the mobile piece, and and really into some of the other segments. And I would say, just overall and generally, quite frankly, this is a great business that's, it's really starting to benefit from the high margins and cash flow generation from our scale that we've created there. So that's, as it continues to be an extremely strong cash generating asset for us, and it's benefiting from all the progress we've made over the last couple of years there.
Yeah. So I'm back on, and I'll explain why we keep coming back on and off in a minute, just to come clean with everybody. We're actually quite bullish on Guatemala for all the reasons that I've just explained. But remember, this is a healthily managed macroeconomic country. All the numbers in Guatemala are good. I think Sheldon was alluding to that. The industry structure is really good. It's not just a two-player market, but it's a market in which both players make money. Both of them are fairly rational. So as we both see our cost structures pressured by inflation, I think there'll be a lot of rationality that will go into that market. So that's the storyline around Guatemala, and hopefully that gives you a lot of good color. Now, you all may be wondering, what's going on with our connection. I happen to be in Africa, in the middle of the Serengeti, and I'm actually on a Tigo Tanzania connection, but I just want to make sure everybody understands that we're not looking for opportunities in Africa. We're done and happy with that. And that explains why some of the connectivity issues that we're having today.
Thanks, Andres. We have time for one more question from Matthew at Barclays. Matthew?
Can you hear me?
Yes.
Thank you. Hi, good morning. Thank you for taking the question. So, Mauricio, in your introductory remarks, you mentioned a tougher macro environment. In that context, I was wondering if you could give a little bit of color in terms of the impacts of this deteriorated environment. First, in terms of the energy, if you can remind us, update us on what kind of hedging you have for energy costs this year and next year. And then looking at the other side of the coin, in terms of pricing power, I realize that in some markets it's quite consolidated, but how easy is it to pass price increases or more for more initiatives in your countries overall? Thank you.
Thank you, Matthew. So it's a good question. As I said on the initial remarks, it's difficult to imagine that we would be absolutely immune to a global recession. We certainly are no superhero group here, but the pandemic showed that we can be very, very adept at making our OCF and our equity free cash flow very resilient in the context of difficult macroeconomic crises. Now, this will sound a little bit strange, but as you see on the Q2 results, it's having little to no effect. Little to no effect. Now, going forward, that's not the view we're taking, and that's why my remarks were more balanced. We remained convinced that we're going to hit our targets, but we're putting extra work to get there because we knew this recession, as everybody should have, was a possibility. As a result of that, there's two sides to the equation. One is the cost effect and how we will be able to mitigate that. Some costs are indeed going up, like energy and labor in particular, but energy is only a fraction of our costs, 2% or so. Labor is a little bit more important. In some countries like Paraguay and Colombia have seen wage increases, but we have successfully already mitigated those impacts throughout this year. These wage increases were actually made at the very early part of this year, and we've been able to manage through those by making savings elsewhere. And as a result of that, you see our EBITDA margins not only have remained flat, but consistent with prior quarters and our prior year in particular. We started working, as we always do, on everything to do with driving efficiency into the operations. Just about every quarter since we've been around, we've driven OCF margins up and EBITDA margins up, and this last quarter was no exception. And we will continue to do that on the back of efficiency programs that we put in place early this year in a very disciplined manner. They will be largely digital driven going forward, but they're happening as we speak because this is a consistent drive to get efficiency. So that's on the cost side. Now, on the revenue side, our ability to pass on some of this inflation. And remember, in some countries, it's only 5% like Guatemala, in others, it's a little bit more like Paraguay and Colombia. How long will inflation last? Your bet is as good as mine. My personal view is that it won't be very long because you've already begun to see that peak in some of our countries. But the ability to pass on some of that to our subscribers has already been tested. We've been doing a little bit of that already in some markets more than others. The industry structures in our markets are very good. In 5 out of all our countries, it's a 2-player market. In many of those, we compete against companies that are not only rational, but are also facing the exact same issues. So everybody's on the same boat. So we will have better industry structures and more incentives as an industry to pass on that perhaps operators in other markets may have. And the last bit of this, because the ability to pass on is not just a function of the industry structure, it's also a function of the available money in the pockets of consumers. And I would only point you to something that you already know, Matthew, which is remittances. And 2 points that we make there. They've remained high and growing. As up until last month, June, which is the last numbers we've had, they continue to grow 20%. And this is on the back of really big numbers. In some of our markets are 20 to 25. Bolivia in particular is beginning to see high remittances, which we hadn't before. And Guatemala, Nicaragua, all continue to receive high levels and growing levels of remittances. And as you likely know, in times of crisis, remittances actually tend to grow. And this gives us, given our history in these markets, an important level of confidence. Remittances from the US. And a stronger dollar and inflation in the US obviously will only help the absolute number. So those are the reasons why we think we stand a fairly decent chance of being able to pass on some of the subscriber base. So you can imagine how we're going to play this. We're going to play this on the cost sides. with very clear goals on maintaining, sustaining our margins, growing that EBITDA margin continuously, and that OCF driving it to that 10% operating cash flow growth. But doing that by continuing to drive our OCF margins, which are already at 23%. We have a pretty decent track record in doing that. And on the revenue side, on top of everything that I have just said, we're very cognizant that in times like this, volume remains our long-term objective. Our business plan is volume driven, bringing more customer base to a fixed cost, great size and scale in our markets, in under-penetrated markets. But throughout the shorter term, a lot of focus on ARPU is what helps win the day during these moments. And that is why we're so focused on defending ARPU during these inflationary times. And I've already outlined how we aim to do that.
Great, thank you very much.
You bet.
Thanks, Matthew. That was our last call, so our last question. So Mauricio, I don't know if you want to make any closing remarks.
Well, thank you for joining us today. We like the results we put out today. We believe we're delivering everything we said we were going to deliver, and we're happy about that. We have renewed confidence despite the macro headwinds that we will deliver on.
Sorry, look, I just finished here for Mauricio, but look, like I said, I think we're very happy with the quarter and very happy with the performance, and to continue to see the broad-based revenue growth that we've achieved, across the business, and as well as the momentum we're starting to see on the EBITDA side, year over year. So with that, Mauricio, I guess you're back on, but I think with that, we're thanks for your time, and I look forward to speaking with you next quarter.
I think you probably did a phenomenal job, Sheldon. The key message is we're on track and we're going to deliver on that 3-year plan that we promised out earlier this year. Thanks for joining today.
Right, thanks.